come back to that a little bit, Dan. You talked about the three kind of open sourcing trading secrets that the Ivy League endowments use. So that's something that you're kind of using in benchmarking and finding managers. So talk about those a little bit.
Right. So the three things that go into investing IQ are risk-adjusted returns, which is based on information ratio. Did the investment manager beat the market over a long period of time? And it compares a standard deviation of monthly returns versus the market, and sticks to strategy. So we make our investment managers declare whether they're a value investor, a growth investor, a macro investor, dividend investor, tactical asset allocation investor, and we measure attribution on where do they make the returns. So Matt, if you are investing on Kaching as a customer of an investment manager that's a value investor, and his returns, he's buying a bunch of growth stocks like Google or Baidu and whatnot, he's trading from a strategy. Yeah. So that'll show up in the attribution, and he'll get very low scores on sticks to strategy. Now, in addition, when you're actually mirroring one of the investment managers in your brokerage account, if that investment manager starts straying from his strategy, we send you real-time email updates. We call real-time drift alerts. If, let's say, their investing IQ starts plummeting and the risk starts increasing, or they're straying from the strategy, we'll say, hey, Matt, we noticed your investment manager is straying from the strategy. We wanted to let you know.
Yeah, so that's powerful because, again, most people, again, if I'm running a strategy that's short only, or short bias, 90%, 10% long, and it's the market's trending up, it's going to be a tough market for me. But if I stick to my strategy and look for those short opportunities, I will make money. But if I do start drifting, as you said, starting to play small cap growth stories, well, that's on the long side, that's really getting away from my core competencies, and
exactly.
I would want to know that as an investor.
Exactly, and the Ivy League endowments, they don't deploy tens of millions of dollars. They deploy hundreds of millions of dollars, so they can demand this type of transparency that the average customer doesn't get when they try to buy a mutual fund. So it's interesting, but yeah, I mean, when an Ivy League endowment is investing in an investment manager, they sit down and they ask him, tell me your 10 largest positions and why you own them. Right. And some people would have no idea. They'd be like, And when the Ivy League endowments are diversifying their alpha across different investment arenas, if they're putting money with value investors, they want them to stay solely with value because it's how they're diversifying their alpha across different asset classes. And so that guy that is 100% short, people are using him as a level of diversification.
Absolutely. So yeah, I mean, they're all asset classes, and the proper diversification comes from knowing and being comforted by the fact that I know that my short manager is shorting, and I know that my value guy is buying value. That's the only way that you're going to get true diversification. You're not going to get it from somebody who's, hey, I'm a seat of the pants guy, and I'm going to go with whatever is hot today or whatever's cold today. I'm going to fade. That's not really a strategy, or it could be, but that's got to be the strategy. I got, flavor of the month guy. But
the flavor of the month guy isn't the guy that'll consistently earn positive alpha over time.
No, you're absolutely right. He won't. But if that's his strategy, then I know that at least is his strategy. Is the flavor of the month, I guess, was my point. So as an investor, I want to know that guy's sitting in that space.
Right. And that type of investment manager just won't fit in our product. It just won't. And that's fine. I mean, we want to be able to have a product where everyone falls into their mandate, because if so, we can provide a very good level of detail of diversification of your alpha. If you want to invest in 5 investment managers, Matt, on Kaching, we can tell you what your correlations are, what the different expected outcomes based on, if you're investing in a bunch of investment managers that all are high beta, well, you don't want that because they're going to do better on the upside, but they're going to do worse on the downside. And so you want to be able to diversify your alpha, and that's what this transparency kind of allows us to do.
And again, this is huge. Another thing, I want to ask you your thought process in coming up with the behavioral algorithm that you've got in your model. Talk to me a little bit about how you've developed that and are using that.
So investing IQ, the biggest component of investing IQ is research. Reason being is we've had over 425,000 portfolios for over a year and a half to crunch this data and analyze returns, analyze investors, analyze research, and we hired a behavioral learning person from that came over to Kaching that has been instrumental in kind of building a lot of these algorithms for us. And so the research portion is one half of your investing IQ. We've found that research is what separates the man from the boys.
Right.
It's what you can't get if you're looking on CNBC to get a stock idea, or if you're on StockTwits, or if you're on reading someone's blog. If you're just getting ideas from without giving any analysis, then you can still have high returns, and it might just be because you're piggybacking off someone. But the research is kind of what separates the man from the boys, of what we found.
Okay.
So it's 100 points is the highest score you can get on research, and then 50 points each for risk-adjusted returns and sticks to strategy.